Okay, chapter 9. Let's go through this. So what we're looking at here is if you like decision making when it comes to budgets. And because people are constantly using budgets to measure performance, of course, that's kind of one of the fundamental reasons of keeping that. You have these targets. We have other tools that we're going to explore here. So we're going to be looking at along this the same theme, looking at measures for productivity, efficiency ratios that enable us to assess profitability and how the business is, how the business could be doing. So first of all, again, like I say here, we're looking at for performance indicators, and typically there's such a range. I mean, there's a range of things that we could be doing when we're looking at variances here. So of course, we are looking at the average selling price. Are we able to increase the selling price? What's going on with the what percentage of our revenue are we keeping for ourselves? We could be looking at the material cost per unit. The point is, there's lots of things we can be looking at here in order to improve performances. And of course, typically, um, I think I mentioned it in our last class, this question of um, even variances need to be compared to what the normal would be. And like I said, every organization or every industry will accept that there is a certain, if you like, normal with reject rates of what we consider to be normal. And a certain normal as to how many products we expect to be made per hour, a certain normal with idle time, if you like. And so these are all measures, if you like, that we can always assess and see, if you like, and look in terms of variances and see how the organization itself is actually doing. And really, a couple of things here, a couple of definitions here. There's a third one I'd like to introduce called economy. And economy is how we're able to get the not the cheapest, but the best bargain, if you like, in terms of getting our raw materials. That's the first thing. How efficient are we at actually getting that kind of the best inputs, if you like. That's the first thing. And efficiency really is that relationship between inputs and outputs. And we've been doing that a lot. So a lot of our variances has been a discussion about inputs and outputs. How efficiently are we using those inputs? So ideally, of course, we would like to put in less input to get the same amount of output, but that's what variance analysis is fundamentally about. Um, Kilograms and labor hours. We have standards that we compare to what we're actually used, and the whole aim is to try and use less of that, of course, to get the same amount of output. And effectiveness is really a sense of have we actually achieved the target. So the first thing we're going to look at, of course, is ratio analysis, because ratio analysis is fundamental. We talked about it in financial statements. This should be revision for you. We use it to compare performance from one year to the next, to compare between industries, and that kind of thing. So the classic ratios, of course, here are profitability, liquidity, gearing, and investment, and we're going to be looking at those as we plow along. So they give you generally a basic example that we're going to look at or use through the chapter, or most of the chapter, to sort of see and assess how you look at these ratios. And then we have him sort of, you're given an income statement and also a statement of a balance sheet to use through the accounts. And there you are. So you have some prior year notes as well. So profitability. What is interesting about profitability? We are fundamentally asking ourselves, how much of this income are we keeping for ourselves? That's one of the first things that we're asking ourselves. So profitability on its own is asking that question. What is the profit margin? For every £100 that you receive in revenue, how much profit are you keeping for yourself? And that's what this profit turn. So if your profit over turnover is 10 over 100, it means that you're keeping 10%, right, of what it is you are receiving, if you like, through the doors, and that you want to keep as much of that as possible. And so those are the businesses that we're interested in, or we would want to invest in. So the point here is that these are all measures of profitability. This here is a measure of what's referred to as productivity. How efficiently. So not only are we interested in how much are you keeping of your every £100 that you receive, but also how efficiently are you using your assets to generate turnover. So you have your assets which you buy at the beginning of the year, and of course you want to generate the more turnover, if you like, you have over those assets. So the greater the turnover, well, the higher the turnover of those assets will be, and if you have that turnover of your asset, so in effect, you can see here that what we're really saying here is that profitability and productivity are essential to what comes out as your final return. So the more you're churning out and the more you're keeping for yourself, the greater your return on the capital employed. As a practical case, we sometimes see you get scenarios where profitability can be very high, but you're spending a lot of time um, making these items. So think of an artist who spends, um, I don't know, a whole month creating one painting, if you like, but they would sell that painting for a ridiculous amount of money. So high profit margins, they're low turnover. But think of a farmer who's selling vegetables, very low profit margins because there's vegetables there, but they turn over a lot. So those two things, in effect, connect together to arrive at return on capital. And I know I discussed this at financial statements, but in terms of when we get questions about how do we improve these areas here, when you're talking about improving return on capital employed, you're looking at profit margin and asset turnover. These are the two things you're constantly assessing. If you're assessing how do you improve profit margin, you're trying to, of course, improve your profits, of course, or like because it's turnover less cost of sales gives you gross profit. So you think, how do you increase your turnover? How do you reduce your cost of sales? If you like, those are how do you increase your sales price? Forgive me, and how reduce your costs. And of course, with turnover, technically, when I say reduce your assets, you want to make sure that your turnover is churning much more than your assets. So for whatever assets you have, you want to be using them productively and efficiently. So I would have probably gone more along the lines of trying to inspire your staff and try to maintain your machines or getting the most efficient machines in place and trying to reduce wastage and that sort of thing. So that's the first thing that we can do in terms of return on capital employed, and that's the main return on capital employed. Really, is the main test of profitability in terms of profitability, um, if you like, that we're talking about. But of course, we go and we break. So that's return on capital employed, but that is composed of these two assets here. I mean, well, so first of all, I believe they calculate return on capital employed, and return on capital employed, of course, here is profit, because we're talking about here a company that is profit before interest and tax. So if you come up here we are, profit um, before interest and tax, because really this is really the profit here. Um, these here aren't to do with these are almost like overhead costs, aren't they? They're not really to do with the running of the business. They tell us nothing per se about how well we're doing in production or making the product, but they are just painful costs, finance costs and tax, if you like, are just things we have to experience, right? So really, in terms of profitability, these are the figures that we are interested in, if you like. So we have those figures, and then of course we divide those by the amount of, so just on its own, even return on capital employed tells you that really I'm asking you, what return have you made on the capital invested? And capital, if you remember, of course, ultimately A is equal to C plus L. So really, if you want to analyze real investment in a business in terms of how well those assets are working, those assets were arrived at, those non-current assets that you bought were arrived at by the capital and long-term liability used to acquire those assets, which is why you have a formula that looks like this: profit before interest and tax divided by capital, of course, reserves and long-term debt. Yes, so that's your capital plus your loans, because all these would have contributed to acquiring the actual hardcore assets that you are using. Then, of course, they go on to talk about profit margins. Again, it's what it is, like I said there, profit before interest and tax divided by turnover. And you can see there, comparing one year to the next, not too very similar actually. Just a slight, I would say, a slight improvement, but there's much more to look at in terms of discussing. So what this is literally saying is that for every £100 you're keeping 8.7 for yourself, in 2009, and in 2008 you're keeping 8.5 for every £100 to yourself. So it's a slight improvement, but nonetheless an improvement, and that is how we look at profit before tax. Again, like I say, that there are certain industries where the margin is a little slow because it's the nature. So we don't just stop there. We need to sort of assess what's going on in the industry as well. What's the situation there? Um, and typically, food retailing, if you like, are good examples of low margins. But of course, alcohol and electronics have pretty high margins. So the point here is with low margins, you're going to want to think about productivity and, if you like, efficiency. But it's also quite possible that you might actually have low margins due to operational issues. So that's really the point here. The point here is that when you have high margins, you have people coming into that industry looking for ways to eliminate those costs and thereby bring down the price, and then gain market share. So in general, those are sort of the things to think about. Asset turnover, I talked about that. How hard are you making those assets actually work? Um, if you like to actually, so we are again comparing turnover, if you like, divided by the assets or the capital employed, if you like, which is really the point there. And again, like I said here, you're trying to boost your turnover, divided by the capital employed. And capital employed there here, and they have gone with the figure of 16,396. Let me just go to example one and pick that up. 16, here we are, total assets less current liability. So really, I would argue that these are your working assets, right? Your hard core working assets. So your total assets less your current liabilities. Those are the actual assets that are working to generate this income. Um, those are the net assets that are being used to generate that figure. Um, yeah, and that's your and those are your um, yeah, that's asset. Those are your That's your asset turnover. Um, hmm, yeah. So I mean, the key point here is that I mentioned earlier on that where you have capital